and welcome to Lyracorp, the podcast where we unpack the trends shaping businesses and economies. I'm Bhakti, your host, and today we are diving into Indian stock market, a story of sharp recoveries, stellar highs, and the current phase that's making investors nervous. Why is the market red right now? What's behind the correction? And how US tariffs, yes, US trade policies, have anything to do with what's happening here. Joining us today is Abhishek Singh, a strategy consultant at Lyracorp. Welcome, Abhishek.
Thanks, Bhakti. Always a pleasure to be here, especially to talk about markets. Let's get into it.
Then let's begin with some context. The Indian stock market saw a massive surge after the COVID 19 crash in 2020. What drove that rally?
Absolutely, that post COVID recovery was one for the books. Let's go back to early 2020. When COVID hit, the market stagned. Nifty 50 dropped by nearly 40% in a matter of weeks, but soon after, the recovery started and it was fast. Why? Three main reasons: liquidity injections, central banks globally, including the RBI, pumped in money, and interest rates were cut. That made borrowing cheap and investing in equities more attractive. Retail participation also exploded thanks to apps like Zerodha and Grow. Millions of first time investors entered the market, and also India's digital and tech led resilience sectors like IT, pharma, and consumer tech bounced back strongly. Global investors saw India as a growth story, especially when China was still dealing with lockdowns, especially between April 2020 and December 2021. Nifty more than doubled, and it was a dream run.
And now we're in 2025 and the mood is very different. The market's down to 6 to 8% from its high this year. What's behind this red zone we are seeing?
You're right, Bhakti. The sentiment has shifted. This is no panic, but yet caution. Let me break it down for you. Global headwinds, the US tariffs. This is one of the biggest undercurrents. The US recently reimposed and expanded tariffs on several categories of Chinese imports, from semiconductors to electric vehicles. Now, even though India isn't the direct target, it affects global supply chains. Markets hate uncertainty. With rising trade tension, investors are moving away from riskier or emerging markets, including India, and parking in funds in US bonds or blue chip stocks. This capital flight means foreign institutional investors are selling Indian assets and putting downwards pressure on our market. The second one is crude oil prices and the inflation pressure. Crude oil has been hovering around 90 plus dollars per barrel again. India imports over 80% of its oil, so any increase has a direct impact on transportation costs, manufacturing margins, and inflation. That put pressure on both companies and consumer sentiments. The third one, the final one, is valuation concerns. Let's be honest, some part of the markets were overheated. Certain mid cap and small cap stocks had gone up by 150 to 200% in just 2 years. So, what are we seeing now is a valuation correction, especially as interest rates globally remain elevated.
That's a great point about US tariffs, Abhishek. Could you go a bit deeper into how exactly these trade actions ripple into India's market?
Of course, think of the global economy as a web of interlinked supply chains. When the US imposes tariffs on China, companies start to rethink their manufacturing location. Some may shift to Vietnam, India, or Mexico. That sounds like an opportunity for India, and it is long term. But in the short term, it creates turbulence. Global manufacturers pause investment decisions. Export heavy sectors, especially IT and engineering, worry about reduced global demand. Investors expect lower profits, especially in sectors with international exposure. On top of that, currency volatility kicks in. The Indian rupee weakens slightly. Foreign investors take that as another reason to exit. So while India is not in the line of fire, we are feeling the tremors.
Let's step back and look at the bigger picture. How does today's market downturn compare to the last few years?
That's an excellent perspective to bring in. 2021 was a euphoric year. Everything rallied: IT, pharma, financials, you name it. 2022 saw a brief pause due to global interest rate hikes, but India still outperformed most emerging markets. 2023 was a mixed bag. Markets were range bound and but still optimistic. 2024 ended on a high with expectations around capex revival and budget spending and also the strong earnings growth. Now in early 2025, we are facing a reality check. Yes, the current rate phase feel painful, but it's also a part of a healthy cycle. No market can rise forever, but think of it as a market taking a breather before the next climb.
Let's make it practical. What's your advice to investors and even businesses trying to navigate this period?
Absolutely, Bhakti. This is the part that matters. For investors, don't panic, don't chase headlines. Corrections are normal. This is not 2008 or 2020. it's a cooling off phase. Rebalance your portfolio, trim excess from overheated sectors, and focus on quality businesses, especially those with low debt and strong cash flow. Avoid timing the market if you are investing for 5 to 10 years. This deep could be an opportunity. For businesses, manage cost pressures while oil prices are rising. Energy and logistic efficiency are the key. Diversify markets, especially if you are in exports, starts looking beyond the US China corridor. Southeast Asia, Africa, and even the Eastern Europe are growing markets. Stay close to customer sentiment. Consumers are watching their wallets. Position your brand accordingly and offer value thought cutting quality.
Before we wrap up today, Abhishek, what's your outlook for the next 6 to 12 months?
Cautiously optimistic, India still has strong fundamentals, demographics, digital adoption, and domestic demand. But the next few quarters will be choppy due to the global noise. If businesses stay agile and investors stay disciplined, the long term story remains intact.